Hi, we're in chapter 5 now, which is on adjustments. Some people find this chapter a little difficult, but if you think of it logically, it's not difficult at all. Accounting is things that we do in our everyday life. So when something is not right in our life, we have to adjust it to make it correct. If a window is sticking, it doesn't go down all the way, you may have to, the adjustment would be to maybe sand it a little on the edges, or maybe to put some lubricant to make the window go up and down. So an adjustment is how we're going to fix the problem. So in chapter 5, we're looking at our balances now, our trial balance at the end of a month. And some of those balances are not current. The trial balance proved that everything balanced, but yet some of those balances may not be up to date. So in chapter 5, we learned how to bring them up to date, current. So I'm actually doing a few problems at the end of the chapter to show you how you do the adjustment. We're starting with chapter 5.1, 5.1a. So in this chapter, in this exercise, the supplies account, if we were looking at a trial balance, the supplies account is showing it has a balance of $320. But we bought $320 at maybe the beginning of December. It's the end of December now. If you look at the date, it's December the 31st. Surely we used up some of those supplies. There's probably not $320 left anymore. So someone has to go count to see what's left. They take an inventory. An inventory shows what's there now. And the problem says that they took a physical count of the inventory, and it showed that $90 remained. Out of the $320, only $90 is remaining. So this $320 is not correct. It should be $90, but we can't scratch it out. So we have to do a debit and a credit. If we just scratched it out and wrote 90, guess what? We would not be in balance anymore. So we have to subtract how much we used up. So an adjusting entry is the amount used. So the adjusting entry is going to go on the decrease side. So I'm going to write something and then erase it. So if we began the month with $320, and at the end of the month we had $90 remaining, subtract, and you found that you used up $230 of supplies that month. So the used amount is the adjustment amount. So we're going to go over to the credit side on the 31st of December. Well, let me just take that away, but it's the 31st of December. I am going to credit or decrease, this is going to be my adjustment, $230 is going to go on my credit side. So if I credit my supplies, I need to debit another account, and I'm going to go to the account supplies expense. Now you're creating an expense account. An expense is when you're paying for something to help run your business. Well, you needed those supplies to run your business. So after you used up the supplies, you can write it off as an expense. You get a tax break. So we're creating an expense that we didn't have now. So I'm going to debit $230 under the supplies expense account. So I'm going to go to my journal. You always have to go to the journal. And I'm going to record on the 31st of December. And in the description column, I'm going to put adjusting ADJ entry, ENT. And the post reference would be, well, when we post it, I'm not posting it to a ledger, so I'm going to leave it blank right now. But we're going to put the debit amount. So I debited $230. My debit was to supplies expense. So I'm going to write the debit name, supplies expense, in the debit column, $230, and I credited my supplies account for $230. My credit is going to be supplies, $230. Now I'm going to go back to my T account or to the ledger after it was posted, and it's going to show the new balance. So I'm going to subtract 230 from 320. My new balance on December the 31st or January the 1st is going to be $90. That is how much I have in supplies, my current inventory. So my adjustment entry is what I used, and that becomes an expense of the business, the used amount. All right, we're going to go to the next one. Prepaid insurance, we're going to do it the same way. It has the same concept. So here we're showing that on December the 1st, an insurance policy was purchased, for a 6-month insurance policy. They purchased 6 months for $900. It is currently the end of December right now, the end of the first month. So we want to subtract how much insurance you use, the cost of 1 month of insurance. So I would divide 6 into, you would do this on scratch paper or your calculator. So I would divide 6 into 900. So that would be $150. So every month we would take away $150. So we used up 1 month of insurance. So my adjustment, I'm going to subtract $150 from the prepaid insurance account, and again, you get to write that off as an expense. You needed to use that insurance. You needed to have insurance for your business for that month. So I'm going to go over to my expense account, and I'm going to add $150. That is my adjustment. I'm going to go to my journal, and I'm going to say December the 31st. I'm going to make an adjustment, and I'm going to write the debit first. Insurance expense. We write debits first. You learned that in the last chapter. So insurance expense, I'm going to debit $150, and I'm going to get my credit amount, which is prepaid insurance. I'm going to credit prepaid insurance for $150. Here's my debit and credit. When it's posted to the ledgers, you're going to show your new balance now in prepaid insurance. So on December the 31st, my new balance is, I'm going to subtract $150 from $900, and I believe it's going to be $750. So she has 5 months of insurance left. Every month we're going to take away another $150. Okay, now the next one I'm going to up here is wage expense. So it looks like on this one, so far for the month of December, the employer has paid wages to the employees of $600. So let's say that, I'm going to say instead of December the 31st, let's say he paid $600 on December the 27th. It is now December the 31st, and his employee may have worked a few more days in December. So you say, do I owe any more wages for this month to my employee? So the book says that, let's see, $200 more in wages has been earned by the employee, but you're not paying them yet until probably January. But that the expense occurred in this month, in the month of December. $200 more wages were earned in December. So we're going to go to wage expense, and we're going to adjust this account by adding $200 to wage expense for the month of December. So that would be December the 31st. I'm adding $200 more that they earned in the month. But since I'm not paying them yet, I'm going to a new account called wages payable. That's a liability account. That means that you owe those wages. So we're going to go to the credit side on December the 31st, and we're going to make an adjustment to this account by adding $200 to the wages payable account. I'm going to record it in my journal on December the 31st, adjusting entry. And I'm going to say wage expense. And we're going to put in $200 debit. And then wages payable, credit, $200. And when that is posted to the ledgers, the wage expense account now changes. I have 2 debits, so now I have a new balance of $800 in the wage expense on the 31st of December. Wages went from $600 to $800, but this $200 is not paid yet. That $600 has already been paid that month. Now the last one we're going to go to is a little different. It's a depreciation of equipment. So depreciation is when something gets old and it wears away and it's not worth what it was worth when you bought it. And all of you know that. I mean, when you buy a new automobile, as soon as you ride it out the parking lot, down the street, you can't get what you paid for it. It depreciated in value. So we're going to take the information that's given to us and find out how much did this piece of equipment depreciate in value. So we need to know some numbers first. We need to know how much did this piece of equipment cost when it was purchased. And the problem says that it cost $5,400 when it was purchased. And it was purchased on December the 1st of this year. So it is now December the 31st. So it's going to depreciate only 1 month, but it did lose value this month. So we're going to start off with when the person bought the equipment, it was worth $5,400. Then you look to see if the book gives you any salvage value. A salvage value means at the end of the car's life. Say if the car is going to last you for 5 years. At the end of 5 years, are you going to sell it for any money? If you are, that's called your salvage value. You have to subtract that from the cost. But most of the problems in your book says no salvage value. So 5,400 minus 0 still equals 5,400. Then still have the formula here. Cost minus salvage divided by the life. Your textbook is going to tell you how long the asset is going to last, how long the equipment is going to last till it's not good anymore. And it said it's going to last for 5 years or 60 months. 5 times 12 is 60. So since I want to know how much it depreciated for 1 month, I'm going to divide 60 into 5,400, and it's going to come out to $90 a month. So that piece of equipment loses in value $90 every month. So since I found that information out, I'm going to go to an account called depreciation expense for the equipment. Because guess what? You get to write off the depreciation. You can't see it getting older, but you get a write-off on your taxes. You get a help with your taxes on that. So I'm going to say I have an adjustment here of $90. I'm going to debit expenses because I'm increasing my expenses $90. Now, I'm going to another new account. You notice this account is called accumulated depreciation for that equipment. I am not going to my equipment account. Accumulated depreciation is what we call a contra asset account. It's going to be connected to the equipment account. and we're going to put how much it depreciates over the cost of its 5 years. But it has a credit balance. So if I debited expense, I'm going to credit accumulated depreciation. So I'm going to add $90 to the credit side of accumulated depreciation. So I'm going to go to my journal. My adjustment is going to say, depreciation expense for the equipment, $90 debit, and accumulated depreciation is a $90 credit. Let me see if there. And now, quickly, I just want to show you one more thing. Oh my goodness. You don't need to show this on the journal, but how much now is that equipment going to be worth? This is called book value. So let me show you right over here. On your balance sheet, when you make your new balance sheet, it's not going to show the equipment's worth $5,400 anymore. So we're going to find the book value. So the book value is cost minus accumulated depreciation. So if the cost is $5,400 and it depreciated $90 for 1 month, so now the book value of that piece of equipment is going to be $5,310. That is the amount that's going to be shown as the value of your asset on December the 31st, not $5,400. So anyway, those were the adjustments, quickly done. So keep going over them, and those are the only four adjustments that you all are going to have in this chapter. So practice, practice, practice makes perfect. So I hope that helped you. Thanks.